Welcome to this explainer. Today, we're diving into a really fascinating high-stakes financial investigation. We're looking at exactly how multinational corporations shift their profits all around the globe. And to do this, we're going to use British American Tobacco, or BAT, as our prime case study. It's this crazy intersection of international finance, local tax law, and a literal billion-dollar tug-of-war for local revenue. And look, understanding these massive capital flows, it's not just some dry accounting exercise. It is absolutely crucial to understanding the modern global economy, figuring out how national budgets actually get funded, and seeing exactly where the line is drawn between, strategic tax planning and the depletion of public resources. Let's get right into it. $941 million. Let that sink in for a second. Back in 2016, according to an analysis by the Tax Justice Network, that estimated massive amount was shifted out of developing countries and straight into a single UK subsidiary. To put that into perspective for you, that figure was roughly 12.3% of BAT's global pre-tax profit for that entire year. We are literally talking about nearly $1 billion in capital generated in emerging markets being legally rerouted back to one specific subsidiary in the United Kingdom. But here's the most striking detail of the whole shebang. Within that specific UK subsidiary, almost no corporate income tax was paid on that vast sum. Crazy, right? Alex Cobham, the chief executive of the Tax Justice Network, has a pretty stark perspective on this. He points out that while tobacco companies make a ton of noise about paying taxes, shifting nearly $1 billion out of developing countries tells a totally different story. In fact, his organization projects that if business continues as usual, 6 developing nations, including places like Bangladesh, Indonesia, and Brazil, stand to lose nearly $700 million in tax revenue by the year 2030. Think about what that actually means on the ground. When a developing country loses hundreds of millions in projected revenue, the impact is huge. We're talking less funding for infrastructure, strained public health initiatives, and underfunded schools in the very areas that desperately need that capital to grow. Now, we've got 2 very different narratives playing out here, and it's important to look at both. On one hand, the Tax Justice Network claims that BAT shifted profits using intra-company royalties and loans specifically to avoid taxes in developing nations, actively depriving those governments of vital funds. But on the flip side, BAT's official stance is a firm denial. They state that they fully comply with all applicable tax legislation in every single country where they operate. They assert that all their transactions are done strictly at arm's length, and they've publicly called the Tax Justice Network's claims of massive tax losses simply not credible. So our goal today is just to impartially examine the mechanics of what's actually happening in these complex transactions so we can understand how both these perspectives are rooted in the current global tax framework. All right, moving on to Section 1, profit shifting and the actual mechanics of how this works.
Let's actually trace the flow of this money. If we look at Bangladesh, profits are legally shifted through things like royalties, advisory fees, and IT charges, and that results in an estimated tax loss of $5.8 million a year. You see, intangibles like IT services or intellectual property royalties are super common vehicles for this, mainly because their true market value can be really tricky for local authorities to verify. Then, if we jump over to Indonesia, the strategy kind of shifts to intra-company loan interest combined with royalties and fees, leading to a potential loss of about $13.7 million annually. And in Brazil, by routing profits offshore to Madeira and paying heavy loan interest, that estimated tax loss jumps to a staggering $33 million per year. Keep in mind, these aren't random external expenses. These are highly specific financial charges executed between different branches of the exact same global corporate entity.
So why does all of this really matter? Well, let's look at the human scale of these numbers. 170,000. In 2016 alone, that estimated $5.8 million tax loss in Bangladesh was enough to cover the per capita health expenditures for over 170,000 citizens for an entire year. When we evaluate corporate profit shifting, we kind of have to balance 2 realities: the corporate ledger and fiduciary duty to shareholders versus the reality of tangible public resources. In developing nations where public funding is in incredibly high demand, just a few $1 million in tax revenue can fundamentally change the landscape of public healthcare and social services.
Okay, let's turn to Section 2, the global standard and the rules of the game. To really grasp the mechanics here, we need to talk about transfer pricing. Simply put, this refers to the rules and methods for pricing transactions, so the sale of goods, services, or intangibles, between associated enterprises operating in different tax jurisdictions. Basically, whenever a multinational company buys from or sells to its own subsidiaries in other countries, it has to set a price for that exchange. And look, transfer pricing itself is a completely normal, absolutely essential business practice for any global company. It's not inherently bad. The friction only pops up when those internal prices are aggressively optimized to move capital out of high tax areas and into low tax havens. Now, the golden rule governing this whole system is called the arm's length price. This rule dictates that the amount charged in an intra-company transaction must be exactly what would have been charged between entirely independent, unrelated parties. Imagine two sibling companies under the same corporate umbrella, right? One manufactures technical components and the other distributes them globally. If the manufacturer sells those components to its sibling at a massive artificial discount just to avoid booking a profit in a high-tax jurisdiction, well, they violate this rule. They have to act like total strangers negotiating a fair competitive market rate. This arm's length principle is the absolute core standard upheld by the OECD and local tax laws worldwide. It's designed to keep internal corporate pricing honest and verifiable. Which brings us to Section 3. Bangladesh fights back, looking at their strict defenses. In response to these massive global capital flows, local tax authorities are fighting back by enacting some really strict regulatory defenses. For example, the National Board of Revenue in Bangladesh has built this comprehensive framework under their Income Tax Act. Imagine the logistical hurdle this creates for a corporation. First, any taxpayer entering an international transaction has to file a formal statement of international transactions right alongside their tax return. Second, if the total value of those transactions goes over 30 million Bangladeshi taka, the company has to maintain a vast, and I mean vast, array of specific transfer pricing documentation. And third, crossing that exact same 30 million taka threshold triggers a rule where they have to submit an independent, certified accountant's report. It's a system that fundamentally increases the daily friction of doing international business. And the burden of proof under Bangladesh's Rule 73, it is absolutely exhaustive. Companies can't just hand in a quick, top-level summary. No way. They have to maintain complete ownership and business profiles of the entire multinational group. They've got to produce consolidated financial statements, detailed contracts mapping out all related party transactions, and super in-depth economic and market comparability analyses. And crucially, they have to show the exact rationale and mathematical calculations for whichever transfer pricing method they chose. Plus, and this is a big one, this isn't just a short-term thing. They are legally obligated to keep all of these records intact for 8 whole years. That long tail of legal liability gives tax authorities plenty of time to audit the math and verify if those intercompany prices were actually fair. Finally, let's look at Section 4, Enforcement and Penalties, and the financial consequences of getting this wrong. The penalties for noncompliance here are incredibly severe, mostly because they scale directly with the transaction size rather than just being flat fines. So, failing to maintain those exhaustive documents or ignoring an audit notice can trigger a penalty of up to 1% of the total transaction value. And if you fail to submit that initial international transaction statement, that penalty gets bumped up to 2%. Now, for multinational corporations moving tens or hundreds of millions of dollars across borders, these percentage-based penalties can instantly turn into massive, multi-million-dollar hits. In fact, a 2% fine on gross transaction value could totally wipe out the net tax savings the corporation was trying to secure in the first place. It completely alters their risk calculus. The National Board of Revenue is enforcing this heavily, using a dedicated transfer pricing cell to actively audit these exact metrics. So, all of this brings us to the ultimate question. Are local transfer pricing regulations actually enough to balance the scales against multinational financial maneuvering? As we've seen today through the lens of British American tobacco and the really strict frameworks rolling out in places like Bangladesh, it's a constant, high-stakes battle. On one side, you have billion-dollar corporations using entirely legal, highly complex global strategies to optimize their capital. But on the other side, you've got local revenue authorities demanding unprecedented transparency to protect their own domestic economies. It really forces us to carefully evaluate who ultimately holds the upper hand in the modern global economy. Well, thank you so much for joining me for this explainer. Keep questioning the data, and I'll see you next time.